and you're going to see more interesting stuff there. So let's start now with chapter 5. Now, once we, again, either we accepting new client, either we assessing the, we're going with the continuing client. We're going through the process of identifying the inherent risk, control risk, in order to come up with the detection risk. So the inherent risk and controlling risk, when we're assessing those one, that's going to help us to see where the detection risk should be, and based on that, we're going to put some audit. That will determine our audit strategy and the audit process, and what kind of audit we're going to conduct in this company. So now let's see today what kind of evidence and documentations we have to go through in order to assess the risks, find the evidence about the risk, and what we have to document. So the financial statements. First, we're going to start with the financial statements. That's the starting point, obviously. Then we're going to have this management assertion about the components of the financial statement. So we have to get the something from the management that actually they saying, okay, that's the financial statements, and everything is in the financial statements. Then we have to, based on that, we're going to assess the risks, and we're going to start working on the audit procedures. Through the audit procedures, what we're trying to find, we're trying to gather evidence. Is what the managers say it's actually true? Once we get enough evidence, then we're going to reach that conclusion. Whatever management says is true, or whatever management says is not true. And then we're going to put it on the financial report, on the audit report. Make sense? It's very logical here. Now, it's when you put it on the big perspective here, it's very logical. Again, we look in the financial statement, we're catching the management. Is this true? Are you sure you're including everything that was happened through the year in terms of transaction? All the transactions are recorded properly. The journal entry are made. They're posted in the right account, and the financial statements represents actual event that happened in the company. They're saying yes. Okay, so then, okay, if they say yes, then we're checking what's the company environment, what's the control risk in the company. Then we determined our materiality based on those risks. We determined our materiality, come up with our audit procedures, which audit procedures is to confirm the only fact that the management actually reported all the transactions. Now, if we see that the environment changing, that means that inherent risk has increased. So we might chase something that management might not tell us, or management think that they have control, but we might think that they don't have control. Then we're going to check the control environment in the company, and that's going to help us, and it's going to determine what will be our procedures. Again, the only purpose for the procedure is we to gather the evidence to confirm that the management actually recorded and reported all the transactions during the period that we're doing the audit. And through this evidence, we're going to reach our conclusion. And we're going to say, yes, actually, in fact, all the transactions are posted. Those transactions are posted with the right amount based on the right documentations in the right accounts, which accounts are reported in the right elements of the financial statements. So yes, financial statement represents actually what's happened in the company or not. And then that's going to stay on the audit report. And that's why we have the four. We have non-qualify, qualify, assertion, and the other one was we just don't accept the audit. So the management assertion, how we gonna get it? The management assertion. So management assertion will be about the classes of transaction and events and related disclosure for the period under the audit. So what we're gonna chase? We're gonna chase occurrence, presentation, classification, cutoff, accuracy, authorization, completeness. So now remember, we need to know, I want you to know what the occurrence means, what's the presentation mean, what classification means, what cutoff means, what accuracy is, what authorization is, what completeness is on the transaction and events. So for that reason, for this one, if you remember, we have to go back all the way to chapter 1. And we have to check on the level of transaction and events, what is each of those. Because that's from where those assertions come from. And we have occurrence, completeness, authorization, accuracy, cutoff, classification, presentation. So that will be the logical order from the occurrence to completeness, authorization, accuracy, which the amount. So basically, let's go one. Do you want me to go again? Repeat those one again. And to see the essence inside the terminology.
Sure.
Okay, occurrence is the transaction and event that has been recorded or disclosed, has actually happened. Completeness. If the transaction event that should have been recorded have been actually recorded. So first we're checking, is this actually happened? Second, if it happened, hasn't been recorded. And obviously disclosed should be included in all the financial statements. Authorization is the event that's supposed to happen, which actually happened and has been recorded, was properly authorized. Accuracy means that the amount and all the information related to that transaction had been actually recorded appropriate. Because I may have event purchase of truck. That event has been recorded in the financial statement through the journal entry. The transaction has been approved, but the amount of the truck was incorrect. Right? So occurrence, completeness, authorization, but on the accuracy, we have a problem. So that's why we need the accuracy. Or we may have, okay, we purchased the truck. The transaction actually has been recorded. Was authorized. The right amount was recorded. But instead of 2024, was recorded in 2025. So it's not in the correct period. Then we're going to check the transaction event that has been recorded in the proper account. So truck has been purchased. We're checking, yes, actually has been purchased. Yes, the transaction was recorded on the journal entry. Yes, was properly authorized. The accurate amount was recorded. in the transaction. It was put in the right fiscal year, but was reported or recorded, was reported in the account of equipment, or was directly expensed. So that's how we're checking the classification. And the last one is that transaction event appropriately aggregated or disaggregated, clearly described in related disclosure and relevant, understandable, complex requirement applicable to financial reporting. So the presentation is, we're going in the very, very last level, which is on the financial reports and the disclosure notes. Everything is there. So that's for the transaction and events. So let's go back to our chapter here. That's how we checking the management assertions on the transaction event. Occurrence, completeness, authorization, accuracy, cutoff, classification, presentation. That should be the right order here. And from the clockwise order, from the occurrence all the way to presentation. Then we're going to have, again, management assertion on the account balances, which was the account balances. On the account balances, we have to go back to chapter 1 and to see the next slide on chapter 1. That's why I told you that chapter 1 was kind of powerful. So in here, we have the management's assertion on the account balances and related disclosure now. So first, we're going to find the existence. Asset, liability, equity actually exist. All right, and obligation. Those entities hold the control the right of the asset. So now, remember, in the first place, we're dealing with the truck. Now, let's say everything happened. Now, we have to find first, is the truck actually exist? Can I see it? Can I touch it? Where exactly is? Second, is the company actually have rights for this asset? Is the company actually owns the truck, or the truck is under lease? What exactly happening there? Completeness. Interest that should have been recorded have been actually recorded. So, and related disclosure should be now, if the truck is actually owned by the company, is it actually recorded as a truck of the company, or was recorded something else? Accuracy, valuation, allocation, asset, liability, equity, interest have been included in the financial in the appropriate amount, and any resulting valuation or allocation adjustment have been appropriately recorded. So now that truck is subject to depreciation. Is that depreciation properly recorded? When it's properly recorded, when it's reported in the financial statement, is it reported as a net of assets, or the depreciation was ignored and the asset is still reported on the original cost? Classification, and that the asset, liability, and equity are recorded in the proper account. Presentation will be asset, liability are appropriately aggregated or disaggregated and clearly described in the disclosure notes. So to some extent here, the classification and presentation overlap here with the classification and presentation, but here we're talking about the transaction, but here we're talking about something bigger. This one is on the bigger level of the assets and liability rather than simple transaction. So those are the assertion levels of the management. So we have two assertions, one for the transaction and events, and the other one is for the account balances, which are related to the assets, liability, and equity. Again, clockwise. We're going for the existence, right obligation, completeness, accuracy, classification, presentation. Presentation is the one that ends up the story. At the end, we have the presentation. Here at the end, we also have the presentation. So now let's go with on the transaction and events. What will be the examples here? Again, on the occurrence and existence, under the transaction and events, under the accounting balances. Transaction and events have been recorded in this clause, have happened, and such transaction events pertain to the entity. On the account balances, those one exist. Rights and obligation, we don't have right and obligation transaction, but we have right and obligation of the account balances. Completeness, we have on both. Authorization, we have only transaction events, not on the balances. Then we're going to the accuracy, valuation, and allocation. Cutoff, we don't have cutoff for the transaction, but we don't have a cutoff for the account balances. Classification we have for both, and the presentation we have for both. So this one is a repetition of chapter 1. Those two slides are repetition of chapter 1, as you can see, but in this case they're put side by side, so you can actually see which one is the related, how those two are related, and which one, where is the overlap. You see on the sum of the assertions, we don't have an overlap. On some of the assertions, we have overlap, like occurrence and existence, overlap, completeness, overlap. On the accuracy, valuation, allocation, we have overlap. Classification, presentation, overlap between both level of session. Now, let's gather some now audit evidence. What's the audit evidence? That's the information which is used by the auditor, which is going to help him to arrive with the conclusion on which he can base the audit opinion. So, what will be the whole idea with the evidence? First, we have to find the nature of the audit evidence. How sufficient and appropriate are those evidence? Then we have to evaluate the evidence. Let's go one of another. The audit assertions. Again, the evidence that we're gathering is to help us to assess the level of assertion for the transaction events and the accounts and balances. So please know those assertions, because for those assertions, you have to gather the evidence through the audit process, putting in place the audit procedures, which is going to give you the evidence that this level of assertion actually is there. So you won't be able to go further if you don't know what drives all the evidence that you have to gather through the audit process, which you have to establish through the audit procedures that you have to come up with in order to say, yes, I gather enough evidence which I can base my opinion now. But again, you need to know what's the level of assertion, or which assertion you actually checking and assessing. Make sense? That's why it's important you to know those level of assertion. Let's go now. Nature of evidence. From where we're going to get? We're going to get from the accounting records and some anything else. What will be the accounting records? We're going to initial records, entries, supporting records, general ledger, sub-ledgers, any journal entry, anything that we can, worksheets, spreadsheets, supporting cost allocation, calculation of the prepaid expenses, amortization tables, on the accrual accounts, from where these accrual accounts coming from, how they coming from, on the accounts receivables, all the related uh, subledgers with the clients, with the analytical with the clients, which shows the balance for each client, which balances when we calculate it together, it's going to give us the ending balance in the accounts receivable account. Accounts payable, the same thing. And that's how we get in those will be the source of the documentation that we're going to start gathering our evidence. Contracts, is there any contracts? That's why I told you every time when you have some major transaction, major event in the company, keep copy of the contracts first, keep copy of the original invoices, because the auditor is going to ask you for those if you're under audit. Other information will be the directors' meetings, minutes of the meetings, some confirmation from the third parties. For example, the confirmation from the third party will be usually the auditor asking for the bank balances at the end of the year, which coming from a big end of the year and the first month of the next year, so they can do the cutoff. That's how we're getting the cutoff assertion, by checking the balances, the bank balance of the month of before the year end and the month after the year end. But that will come from the third party, which will be the bank. Any industry analysis reports. Where is the industry currently? What's the trend in the industry? How is everything related to the industry? Then we have to compare any comparable data from the competitors, control manuals, if you have any control manual, and also information from the industry, observation and inspection. How are we going to assess the sufficiency of our documents? Obviously, based on the sufficiency, that's going to measure the quantity of the audit. Greater risk of the misstatement, more documents we have to do. Less risk of the misstatement, less documents. So, what are we going to determine this? Our detection risk. If the inherent risk is low, if the control risk is low, then our detection risk can be high. In that case, we need less audit evidence, or less lower quantity of the audit evidence in this case. We're not going to chase every single transaction or every second transaction. We're going to limit ourselves on every 15 transactions or something like that. What will be the appropriateness of the audit evidence? Through the appropriateness, so first was the relevance, how relevant they are, and how reliable they are. So if the sufficiency measure the quantity, so we have one measure for the quantity, which is sufficiency, and for the quality we have measure appropriateness. So again, remember this one. Remember those terminology. We're chasing sufficiency, which is just a number of documents that we have, a number of audit evidence. Second one is appropriateness, which is the quality of the documents that we're getting. and how reliable they are. First, obviously, everything which is given from the third party about the company which exists in the company, it's going to be on the high quality. That's why you're not asking the company to give you the bank statement. You telling them to tell the bank to send you the bank statement to you. Same thing like you going to the school and they ask you, show me, give me a proof of your diploma from your country of origin. But I don't want you to give me your diploma. I want you to contact your institution, and that institution to give me to send me the diploma directly to me. That's how uh, the document is appropriate. That's what increased the quality of the document. That's how we gather the evidence. The other one will be the how effective is the internal control in the company. Then we're going to have the auditor's direct personal knowledge. What's the auditor's knowledge? So that's why. So listen, it might be good for you to go to the audit company. Why is that? Because it's going to increase your personal knowledge. You're going to have access to different type of companies, different industry. You're going to face different events, different accounts. You're going to see how you get the evidence, what kind of evidence you're chasing, what exactly on the documentation side, what exactly documents you're doing. Once you know all those things, now when you go to the industry, now you know if this transaction happen, what kind of documents you need, because you already know that those documents already is going to be asked at some point by the auditor. Make sense? So that's why the industry sometimes actually prefer to have a former auditor in the industry, because they already know what kind of evidence the auditor is going to look for, and they can gather the documentation, or if something is not in order, they to put everything in order. So next time when they have audit, there will be no problem. Documentary evidence and original documents. Obviously, the original documents always going to be the high level of proof. But again, it's important from where that original document come from. But if you can find the original document, that will be the best. So the other way to get the evidence is ask the third party to send you that independent source outside of the entity. That will be the confirmation about the accounts receivable balance. Company says this company owes me $500,000. You send you so now what you're doing is you're asking the company to send a letter to that company that you're telling that they owe you $500,000, to send them, you're sending them the letter, which they have to confirm the accounting balance, but not to you, directly to the auditor. So basically, again, you're not getting the letter of the confirmation, the auditor getting it. So you don't know what the other company is going to confirm until they confirm it. So technically, if there's something fishy going on, the other company may say, no, I don't own that money. And that will be considered the independent source of evidence. So let's check your knowledge of knowledge. Which of the following sources of evidence are more reliable? In first case, we have inquiry to accounts receivable clerk versus confirmation sent to a sample of customers. Which one is more reliable?
Account receivable.
Which one?
The first one, the account receivable.
So first one is no. Listen, one and two,
Hmm.
and in one you have two to choose one of them, and for
Oh,
two you have one of them. So the first one option is which one will be more reliable? Accounts receivable clerk. You're asking the accounts receivable clerk to tell you about accounts receivable balances, or you're asking the customer, sample of customer, to send you confirmation letter with the accounts receivables. Which one is
the
more reliable?
Accounts
confirmation letter.
receivable sent to
Yes,
sample of customers?
Yes.
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 Yes, that will be more, right? Because you don't know what's the level of the accounts receivable clerk. What if he finish Alexander School of Management with concentration general business, right? So next one, the two choices that we have is
Third one.
physical examination of the lumber inventory performed by the external auditor, or physical examination of inventory performed by internal auditor.
External auditor.
Right now, yes, external auditor always going to be better unless you 100% relying on internal auditor. Do you know how the let me tell you this. Now this is a real story now. Do you know how the physical examination is done and when it's done? In the audit company, right? Audit company, usually the auditors are close to the year end, preferably on December 31st, exactly on the December 31st. They're sending a team of auditors to do the actual physical examination on the if the company is under the audit on the actual assets and inventory, so that they confirm they can have a solid ground for the starting point for their audit. At least they know that ending balances are correct. So what they're doing is, obviously on those audits that we're gathering those physical evidence, you're not sending the senior auditor because that's too expensive. You're basically sending a junior auditors or somebody who is just trainee, anything like that. Now, the actual process is this. The audit team goes to the company. Usually the company has a security gate with security person sitting in the booth, right? When the audit team arrive, financial controller explicitly tell the security person, you're not letting them in. You keep them there until you tell me exactly what the team is. So what I'm chasing is what the controller chases. What's the nature of the people and their age and their gender? And usually what's happened is if they send young, those are obviously if they're trainee or junior, their age is way younger. If they send mostly guys, now the controller, now there has to be people from the company to tell the auditors where to look, how to look, and what to do. They sending on the opposite gender, which are dressed appropriately to distract the auditors. So when those young gentlemen come to the audit and when they see their companion from the company, they're not thinking about the audit anymore. They start thinking about the opposite gender. But the objective here is they to sign the final paper, which saying what they saw, regardless if they see the opposite gender or looking actually the inventory. So that's a very common practice with the company that doing something. So that's why there was I had experience here. What happened is the daughter of my boss, she was auditor for Ernst & Young, I think, or PwC, one of those. Anyway, she was sent to the physical examination in the mining company in Africa, and she's young, and she tells your mother exactly what I told you. First thing that they're going, nice lunch. Obviously, food will be provided, drinks, everything, plus the nice people walking with you, very nice looking. So the whole thing is distraction. Unfortunately, she was she's very, how can I say, she's very persistent and very focused on what she's doing. So all those tricks didn't work with her, but I'm telling you, they were doing this, we were doing these things when I was in the company, when the auditor was coming on that point, we're doing those things. Now the company is still doing the same things. When was that? That will be how many years after? 25 years after. So nothing changes in the audit world. So let's keep going with with the answers. Again, physical examination is important, and the third-party confirmation is also provide more quality, and it's more reliable than the internal. On the second one is the external, yes. Let's go with the evaluation of the audit evidence. So now once we gather the evidence, we have to evaluate those evidence. Proper evaluation requires understanding the first type of the evidence available, relative reliability of the available evidence. So what we have available and how much we can rely on it. So auditor should be true in searching of the evidence and in bias in the evaluation. Well, that might be very hard if you have a second contract with the company, which tells the company, give them tax advice on anything like that. So that's why you have to be, you have to keep your integrity intact in order to stay unbiased. Procedures. We have procedures, those are specific action which are performed by the auditor to gather the evidence about whether the specific assertion are being met. So that's why it's important to know which assertion you're chasing in order to come up with the specific act which is going to confirm that specific assertion. So that's where the mistakes coming in audit area. You don't know the assertion, you're throwing some act, specific act, which has nothing to do with that assertion. So that's why it's very important you to know what the assertion is about, so you can have the proper example which actually confirm that assertion. So what will be that? That will be the risk assessment procedures. First, something that's assessing the risk. Second, the one that tests the control. And then we have the substantive procedures. So, which is the set of the audit procedures which are prepared to test certain assertion for a component of the financial statements. Those are referred to as an audit program. For the audit assertion, if we have existence, if we're chasing existence, Example will be confirmation of the accounts receivables. That will be the procedure. What will be the evidence is different story. Evidence will be the third-party letter that confirm that balance. Writing obligation. The example for audit procedure will be require management whether the receivables have been sold. What will be the evidence is completely different story. We're chasing about, so you understand now, assertion, procedures, evidence. Completeness. In order to assess the completeness, in audit the assertion completeness, we have to, our procedure should be agree total of the accounts receivable subsidiary ledger to the accounts receivable control accounts. What will be the evidence which gonna use in our to complete our procedures? That will be different story. If we want to audit the assertion related to valuation and allocation, then the audit procedure have to be to test the adequacy of the allowance of doubtful account. What will be the evidence that's going to support that this is actually accurate, adequate? That will be different story. So now we're going to the new terminology. Now we have audit procedure. So imagine we have audit procedure to obtain the audit evidence. We're chasing inspection of records and documents. Evidence which obtained from the external documents obviously is more reliable than internal. We already said that. Occurrence. Assertion occurrence. We're testing it through by doing vouching. What means vouching? Vouching means we're checking the journal ledger account and then we're chasing, show me the source document. Now, if you want to test the completeness, you're chasing the source document and you're linking to the journal ledger. That technique is called tracing. So now on what I want you to do is, if you're smart, I want you to take the level of assertions for the transaction events and for the account balances. Have the definition. And then have the techniques which you're using to confirm that level of assertion. So occurrence, you can confirm it through vouching. Completeness, you can confirm it by tracing. What means tracing? You're tracing the source document to the journal ledger. If you're going from the journal ledger back to the source document, that's called vouching. We're getting to the specific terminology. If you don't use this terminology, if you're in the audit world, you're not going to pass audit exam. Now we're getting this one is this level here of audit, the level here of audit. We're going to the level of day 2 or level of where your elective is audit. If your elective is not going to be audit, one of the 2 electives that you're trying to choose is not going to be audit, then you don't have to worry about the terminology. But if you're choosing to go with the elective audit, you have to know this terminology. That's why for me, audit is like a learning a different language. Now, inspection of tangible assets. How are we gonna inspect that? Physical examination of the tangible assets. Observation is the process of watching a process or procedure being performed by the others. So now I have to know what the observation is. Observation is, let's say, you're going to audit, let's say, a bread maker company, the company that making bread, Wonder Bread, let's say. So one of the you're in charge of gathering evidence about the process of making the dough. What do you have to go? You have to go and observe the actual process by watching the process and taking a note. Inquiry. What's the inquiry? Inquiry is conducting the inquiry. Auditor should consider the knowledge, objectivity, experience, responsibility, qualification of the individual to be questioned. So once you're asking questions to somebody, you have to have in mind that you're checking knowledge, objectivity, experience. Now, the knowledge and experience are not the same. There's not one, oh, he has a knowledge. That's good, but does he have experience? He doesn't have the knowledge. That's okay. Does he have experience? Then we go into the responsibility, and then we go into qualification, because there are many instances that the person have the knowledge, have the experience, but don't have the qualification. Next one is to ask clear, concise, and relevant questions during the inquiry. So basically, here you're like an investigator. Even worse. Then, use open and closed questions appropriately. Be careful when using the questions. If you're looking for answer, which is related to not yes and no, don't use the closed question. So you have to be careful what kind of questions you're asking. Listen actively and effectively during the process of gathering the evidence. Consider the reaction and responses and ask follow-up questions. Again, you have to be here investigator simply. When you ask the question and the person starts mumbling, jumbling, and something like that, that means he's trying to hide something. If he's trying to hide something, then you follow up with the question. Or at some point you have to stop with the questions and start doing some other techniques. And the last thing is evaluate the responses. So let's keep going with this. Confirmation. What's a confirmation? This is the audit evidence obtained by the auditor as a direct written response to the auditor from the third party. So confirmation is not coming from the company. Confirmation is coming from the third party. Now, the reliability of the evidence which are obtained through the external confirmation may be affected by the factors as the form of confirmation, prior experience with the entity, nature of the information, and intended respondent. So, having in mind that on the resume, when you put in your resume, when you're going through the process of the checking the references, you're not going to put on your list of the references persons who's going to give you a negative reference. Having in mind that, put that one in the audit world. And always come from the presumption that if you let the client choose to whom to send the confirmation and accounts balances, the client's always going to choose the one who's going to give correct information or the information that the client needs. For that reason, you're the one who choosing to which client, to which third party the client should send the confirmation letter. Make sense? Everything is related. So, confirmation. Let's go with the information frequently confirmed by the auditor and which is the source of the confirmation. If I want to check the cash balance or the bank balance, you're going to go to the bank. If you want to go to the accounts receivable, confirm the accounts receivables, you're going to go to the clients or the individual customers, and then going to send you the letter directly to you, not to the client that you're doing the audit for. If you want to check the inventory on consignment, you're going to get the information from the consignee. If you want to check the accounts payable, you're going to go to the vendor, and vendor is going to send you the statement to you. If you want to check the bonds payable, you're going to go to the bond holder, and you're going to ask the bond holder for the original document. If you want to check the common shares outstanding, you're going to go to the register, which every single share has to be registered in the documents for the local, what will be that, province and whatever the jurisdictions the company operates. If you want to check the insurance coverage, you're going to go to the insurance company. And keep going, keep going, keep going. Anything which is related, you can get it from the third party. You prefer to get it from the third party. Recalculation. What means recalculation? Recalculation is the checking mathematical accuracy of the documents and the records. Sometimes you can have a transposition error. Sometimes you may have a purpose error. Performance. What means performance? Auditor independent execution of the procedures or control that were originally performed by the company personnel. So you're checking the performance, how that will perform. Analytical procedures, those are the evaluation of financial information made by the study. A relationship among the both financial and non-financial data. Scanning is the judgmentally review of the accounting data to identify significant unusual item to test. Scanning is also when you read the book, you're not reading the book, you're scanning the book. What means is you're chasing only the interesting parts which you want to pay a little bit more attention. The rest of the book, that's not interesting for you. Scanning is now another technique that you're using when you're going over the textbook for the audit. For example, you can go with the scanning. Why is that? Because you have a question in mind that you're looking for the answer. So what you're going to do, you're not going to read the entire book to find the answer. You're going to scan through the book until you find the area which is related to what you want. Vouching. Now we're going to the vouching, which you saw for what is vouching? Vouching is evaluation of financial information through the source of document from the third party. That's why again, evaluation of the financial information through the source documentation from the third party. That's why, as you see, we have a journal, something reported on the journal ledger. Then we're trying to find a supportive document that's called vouching. Tracing. What's the tracing? Using third-party source documents to investigate if the transactions have been appropriately recorded in the accounting system. Is that make sense? Is now this chart here should make sense. Do you remember this? Now the vouching is you know the journal ledger, you seeing the transaction on the records. Let's third party confirm that this document actually exists. Now the tracing is third party give you the document that something happened, then you tracing it, is that has been recorded in the journal ledger. Now through vouching, you testing occurrence. Through tracing, you're testing completeness. Let's keep going with this. Now, what's the general relationship of the evidence? Which one is the higher level? Which one is the lower level? Higher level is the inspection of the tangible assets, reperformance, recalculation. Lower level is observation, inquiry, probably scanning. Then in the middle is the inspection of the record documents, confirmation, analytical procedure, scanning. Actually, scanning is in the middle, but I can easily put the scanning on the lower level. So, hierarchy of the evidence, another thing. Let's see what's the thing. After assessing the potential effectiveness of the internal control, will test the control be conducted? If answer is yes, that means that will be public company. If answer is no, then we're going somewhere else. So if it's not, if it's yes, then we have to perform the test of control. If answer is no, we're not doing the test, perform test of control. Can effective and efficient substantive analytical procedure be performed? If the answer is no, then we're going all the way to substantive details on the transaction on the balances. If the answer is yes, then we're going to perform substantive analytical procedures. In addition to the substantive evidence needed, is the additional substantive evidence needed? If we don't need it, then we're going to go to the document and we're going to find the document's results. If it's yes, we're going to perform the substantive test of the details, transaction, and the balances, which is going to the very, very basic level of the accounting. So we're going to find out, is this transaction actually been recorded? And if it's recorded, then we're going to trace it to the assets and liability all the way to the report. Let's move to the next one. Just a second. Now, let's make it smaller. Back to smaller, to the original size. So, again, based on the desired assurance that we want to check, from what we're going to base the desired assurance? Based on the detection risk. How are we going to get the detection risk? By evaluating first inherent risk and the control risk. We're going to see where the audit risk we want to be. Then we're going to go to the detection risk. In order to confirm that number on the to achieve the detection risk, we start chasing the documents and evidence. Procedures and evidence put in place in order to get that level of assurance that we want. So, what will be that? Remaining assurance. So first we're going to start with the risk assessment procedures. Then we're going to test the control. Then if we're not satisfied, we're going to go with the substantive analytical procedures. And the rest will be the remaining assurance needed to test some details. That's how we're getting all the way to the 100%. And now we're gonna go with the, as you can see on the bottom, those are assertion level: completeness, accuracy, cutoff, presentation, existence, valuation, rights and obligation. Now, control testing and risk assessment procedures, we're gonna put everywhere. Substantive analytical procedures, we're going to decide where to put it. Test of the details, we're going to decide where to put it. So basically, if this is accounts payable, how are we going to test each of the level of assertion? Through the control testing, through the substantive analytical procedure, to the test of the details, when we're choosing which one of the assertion, how to test it. As you can see, like for example, cutoff, we can test it through the control testing, through the substantive analytical procedures, and from the test of the details. Presentation, the actual presentation, we can only test it from the details. Why? Because we already tested transactions, the completeness, the accuracy, the cutoff, the existence, and valuation. We already test those ones. So the presentation, we don't have to put substantive analytical procedures. We just, since we tested on the lower level of the before become a presentation, most likely the presentation will be there. So that's how you have to understand which one is the a proper way and how we're going to test each level of assertion. Let's see this knowledge of assessment, what they're going to say. Consider the assurance bucket analogy. Why are some of the buckets larger than the other for the particular assertion and accounts? So here, once we see this chart, the question is, why some of those buckets are higher, some of them are smaller? What do you think? Any ideas?
I was thinking maybe not how difficult, but maybe how, I won't say how long the process is, but
The quantity.
the amount of time you have to spend on each.
So once you ask questions like this, which slide is this? Slide 29. So what we have to remind ourselves is, what's this chapter about? This chapter is about
Evidences and
evidence
documents.
and documentation. So when you see a big bucket like this, let's go back to chart 29. If you see a big bucket like this, what that means? We have to have more.
It's more because it's more things that are completed, more transactions completed.
So watch this.
Documents.
Again, what's the chapter about?
It's
Evidence.
more evidence.
Evidence and
documentation.
documents. So when we go to slide 29, why the bucket is too big? Because we need more
evidence.
More evidence and more
and
documentation.
documents. There we go. Make it simple, people. Make it logical. If the chapter is about the evidence and documents, that's why we need big bucket, because we need more evidence and more documents Why? Because we want to reach our level of assertion, which is going to guarantee that audit risk is in the level that we want to be. Make sense? We're going to put more procedures. Why are we putting more procedures? Because we're chasing more evidence. Make it logical, please. Try to stay logical. Try to stay on the topic that you are. So now let's audit documentation. Now those are the, up to this point we're chasing the evidence. Now let's see what's the audit documentation. Auditor's record of the audit procedures perform relevant relevant evidence obtained, and the conclusions reached. So in the audit documents, what we're going to find? Records of the audit procedures which are done, relevant evidence which were gathered, and conclusion. Three functions to provide support for the audit report, to help the planning, performance, and supervision of the audit, and to provide the focal point for review work of the subordinates, and provide the basis for the quality review. Which are the audit documents? What they have to be? First, they have to demonstrate how the audit complied with the auditing and related professional practice standards. Second, to support the basis of the auditor conclusion. And the third one is to demonstrate that underlying account records agree or reconciled with the financial statements. So everything that we're doing is to confirm. Remember, our job is to confirm that the financial statements are actually accurately stating what happened in the company. So we're chasing all the way down to the journal entry in order to do what? To confirm the financial statements are accurate. That's all. Fourth one is to include the written audit program detailing the audit procedures necessary to accomplish the audit objectives, and enable knowledgeable and experienced reviewer to understand the nature, timing, existence, result, audit procedure, evidence obtained, and conclusion reached, and determine who performed and reviewed the work, as well as dates and the work and the review. So that's why on the audit documents, they're always going to be abbreviation and date. On which date, which procedures was performed, who did it, and how he did it. Most public accounting company, they have to have two types of files, permanent and current files. Permanent file is the corporate chapter, all the contracts. So that's why I'm telling you, every time when you sign the contract with somebody, make a copy, because auditor is going to ask you why, because he needed for his permanent file. Chart of the accounts, internal control documents, organization chart, terms of shares and bonds issued. So basically you're chasing from where the capital comes, long-term capital, and prior year analytical procedures. Now, if it's the first time client, then the last one is going to disappear, or you can ask for the previous auditor. Current files, which is those are the permanent files about the business. So you can see those are more general files. Now let's go to the current files. Current files is for the current audit. We're chasing now adjusting journal entries, which happen at the end of the period. We're going to see how they're shifting the income from one period to another period, what the technique they're using, how they're using the accounting policy for that. Audit plan and programs. Reclassification journal entries. Sometimes we have to do some changes in there based on what we found in the audit. So we're going to do those adjusting journal entries. at the end of the period, or some journal entries that we have to do as auditors. They're always adjusting entries from the auditor. Working trial balance. Obviously, you need that working trial balance. Current financial statement and auditor report, minute of the meeting, working paper supporting accounts. Those are the two type of files that you need. Now, what's the format of the documents? Now we're going to go deep in the documents. They have to have heading, they have to have index and cross referencings, and have to have a tick marks. Now, this is how it's going to be, but later I'm going to show you other things. So first, payee, who is the payee, what's the amount, what kind of explanation we have in terms of the evidence that we gather. And then we're going to have this here will be tick of the legend. V means vouching, F footed, and TB and related to the trial balance. That's how it's going to be. So now the next thing that we have to do is to who was the owner, who owns the audit document, where to put the archive, and how to retain it. Audit documents should be organized so the audit team members and others can find it. All the audit documents is property of the auditor, including the documents prepared by the entity's auditor request. And this act requires the audit documents to be retained for the number of years from the completion of the date of the engagement. Purpose of the audit procedures. Why do we need these audit procedures? First, for the risk assessment, to do the substantive analytical and final analytical procedures. Risk assessment procedures we're going to use to assist the auditor to better understand the business, plan the nature and timing of the audit. Substantive analytical procedures will be used to obtain the evidential matter, so this will do gathering the evidence. And the final analytical procedures to use the overall review of financial information in the final review stage of the audit. Type of analytical procedures, which is those analytical procedures, trend analysis, ratio analysis, reasonableness analysis. So trend analysis is based on the information of the 3 years, not 2 years. 2 years, we can talk about the differences. For the trend analysis, we need at least 3 years. Ratio analysis is comparison with one ratio to another ratio year over year. Reasonableness will be how reasonable is, for example, the warranty provision. How reasonable is the allowance for doubtful account? How reasonable is this asset to be amortized, or the amortization method used to be unit of measure rather than double declining amortization, or double declining balance to be used as an amortization method for that particular asset. That's how we're chasing the reasonableness of the evidence that we have. So how is going to work? We're going to develop our expectations. It's always based on the expectation. What do you want? Then we're going to develop, once we have the expectation, we're going to define the tolerable differences or tolerable mistake. We're going to compare the expectation to the recorded amount. Is the difference greater than the tolerable difference? If it's no, then we are fine. If it's yes, then we have to start investigate differences. Is there any explanation? If there's no, we have to conduct all other audit procedures in order to come up with the our tolerable difference is not to be too much. And if everything passes, we're going to the document results. Our objective is to get the document results. How are we going to develop expectation? Let's go first one after another. Audit standards require auditor to have expectation whether the analytical procedures are used. The expectation can be developed by using the variety information sources. First will be the financial and operating data, budget forecast, industry publication, competition, management analysis, analytical reports. That's how we're going to start develop our expectations. Then we're going to go to the quality of our expectation. We're going to measure the potential effectiveness of the analytical procedures, the degree of the reliance, and how closely the expectation approximate to the correct but unknown amount. So, again, we're going to the degree of desired precisions, function of the materiality. If the assertion being tested require a low level of detection risk, and for more precise expectation, more extensive and expensive audit procedures, that means we want to lower the detection risk. So, if the detection risk is low, less evidence. If the precision is low, less evidence. If the effectiveness of procedure we're chasing is low, less evidence. If you want to high, then we have to increase everything. I mean, the detection risk, if detection risk is high, then less procedure. But if you want the detection risk to be low, then we have to increase, and we have to be careful with all the evidence that we get and the expectation that we get. Precisions, if we had high precisions, then we have to increase everything, and we want extensive procedures. Again, we need to increase everything, the quality of our expectation. So develop expectation. Now, form factor which is effective the precision of the analytical procedures, that will be this aggregation, the plausibility or predictability of the relationship, data reliability, and type of the analytical procedures which are used to form the expectations. Tolerable differences, how are we going to define that tolerable difference? That will be based on the size of the tolerable difference, and now we're going to find the significance of the amount. If the first the amounts, so how big are the amounts? Is the company working with the small amounts or the big amounts? What's the relatively desired degree of the reliance, level of disagreement, and precisions? And then we have to compare the expectations to what we already recorded and to see are we in our tolerable difference, which the difference we already established. Now, once we come up with this, then we're going to see the differences. If the differences is greater than the tolerable difference, if we set up the tolerable difference to be one amount and the actual investigated difference is greater, then we have to investigate. And we have to put some substantive analytical procedures so we can reduce our possibility of the misstatement, which is the expectation of the significant differences. That will be quantification, corroboration, and evaluation. Now we're going with the different terminology. As you can see, it's getting heavier and heavier, but it's logical. The good thing is audit is logical. Yes, it adding new terminology, but at the end of the day, everything is Makes sense. Now, what's the quantification? Quantification involving determine whether the expectation or error can be explained the observable differences. Corroboration will be audited must corroborate examination by obtaining sufficient appropriate audit evidence linking the explanation of the differences and substanding that the information supporting the explanations is reliable. So we have the difference, we have the documentation. Is this document actually support and explain what happened? Evaluation is the auditor should evaluate the results of the substantive analytical procedures in order to conclude whether the desired level of assurance has been achieved. Again, everything is to the level of assurance. Did we get the level of assurance that we want? Now, on the investigating the differences in the risk assessment, that will be the risk assessment procedure differences and final analytical procedure differences. If the corroboration evidence is not required, that means risk assessment procedures differences, those are used for the planning, everything's fine. Analytical, if we have final analytical procedure differences, corroboration evidence is required. Let's see what you think about this. Primary objective of a final analytical procedures. Which one you think is the right one? Any ideas?
B, maybe? B?
Identify areas that represent specific risks relevant to the audit. That won't be. That will be on the determine the audit process and audit procedures, rather than the final analytical procedures. So the final analytical procedures, if you're going to go to the final analytical procedures, again, those are the, what was that? Where was exactly the chart here? Let me see. Investigate the difference, consider make inquiries. Is the difference greater than the, so if the difference is greater than the tolerable difference, then we're going to go with this extensive procedures in order to, the only reason for those one is we to make sure that the audit actually meet the purposes and we're getting the final analytical procedure used to for the overall review of financial information in the final review stage of the audit, in order we to conclude that the audit actually, the company actually is everything is reported accurately. So basically, the final analytical procedure is going to help us to assess the validity of the conclusion reached of the audit.
The audit, right?
Right.
Okay.
Now let's see some short-term liquidity ratio. You already know the short-term liquidity ratio. I don't have to tell you. That will be the current ratio, quick ratio, and operating cash flow ratio. You remember the difference between the current ratio and quick ratio, right?
No.
No? Current ratio including current assets versus current liability. In the quick ratio, you still have the current liability as a denominator, but on the nominator, from the current assets, you start cutting the assets which are current but not so current. What that means is more heavy to be converted in cash. Which will be that? That will be the inventory, because the inventory, it will be, if the accounts receivables can be easily converted to cash, then the inventory first have to move to the accounts receivable and then converted to cash. So it's more heavy to be converted to cash first. And the second one is the prepaid expenses. Now the chances you to go and ask for your money back on the prepaid expenses are pretty much zero. And you're putting us a prepaid expenses for only purpose to match the expense with the period to which the expenses are related to. So for that reason, prepaid expenses, yes, it's a current asset, but the chances to be converting cash is pretty much zero. So that's why it's eliminated when we're doing the quick ratio. Make sense? Let's say you prepare for the insurance for 1 year. Is this expense for you? No. What is it? Prepaid expense. When you're going to become expense? When the period pass. Now, what are the chances you to convert, to go to the insurance company and say, I want to cancel my insurance, give me my money back? Only when you're closing the business. Otherwise, you're never going to go that direction. And operating cash flow ratios, that will be operating cash flow that will be related to the only the cash that they're using for the current operations. So now activity ratios. Activity ratios are related to the accounts receivable turnover and inventory turnover. So once we get the turnover ratio, we can see how many days accounts receivables are outstanding and how many days inventory we have the inventory on hand. Now the receivable, once we get the receivable turnover, we're going to get it to receivable turnover, we're going to get it through our credit sales divided by average accounts receivables, and inventory turnover, we're going to get it cost of goods sold divided by the average inventory. That's clear. But the day outstanding, and we're going to get it once we get the turnover become our denominator, and our numerator will be 365, which is the day of the year. So what we're chasing here is those receivable turnover, inventory turnover to be high number. If it's high number, that means we have it less days in outstanding or less days in our inventory. If it's low number, that means the days inventory is too high. So imagine if the inventory turnover is 1, that means we're selling our inventory only once. If the receivable turnover is 1, that means we're collecting our credit sales only once a year. The days that inventory stays in our accounts, the accounts receivable stays, we collecting the inventory is 365. And the days that inventory stays on hand is 365 days. So imagine if you are on the bread making business and you're selling the bread, and your inventory stays in your the bread stays in your inventory 365 days. That's not very good. The next thing that we have to chase is the profitability ratio. We're going to get the gross profit percentage, profit margin, return on assets, and return on equity. And the last one is the coverage ratio, but coverage ratio always take it that will be debt to equity, but always consider it with the time interest earn ratio, because sometimes you may see interesting things, the company getting more debt, but the time interest ratio increasing. That means the company don't have problem to pay the additional debt that they're taking, and actually they're generating return. Basically, it's more profitable for the company to borrow money rather than to ask for the investments, because the borrowing is cheaper. And that's how we getting the evidence and documents in order to support our audit and come up with the audit decision for the final audit. As you can see today,